Hello and welcome to this special episode of Weekend Investing Bites. There are losses all around us. I mean, we look around and we study any stock in the market, and we'll find that most stocks are down from their all time highs 30%, 40%, 50%. And very few stocks are actually uh, remaining within some reasonable distance from their all time highs. So, within the entire universe of the market, the variation of how much stocks have fallen from their top is huge. So if we are good stock pickers and our stocks are doing all right, we will be sitting in that bracket of where stocks have lost just 5, 10, 20%. If we are an average stock picker, the portfolio will have losses of 30 to 50% on most stocks from the top. I'm saying, I mean, you may still be sitting on 200% gains from where you bought, but what my reference point right now is how much has the portfolio fallen from the top, how much has each stock fallen from the top. And if we are poor stock pickers, we are sitting at below 50% uh, in terms of fall from the all-time high. So 60%, 70%, 80% drop from an all-time high, or even from your purchase price. So you talk to people in the market, most people are sitting in losses. What should you do? I mean, a lot of folks are seeing this for the first time in their market experience, that the market is coming off this way. Some more seasoned players have seen this cycle play out. Those who came before COVID would have experienced a short bear market in March 2020, where Nifty dropped to 35, 38%. And then the portfolio went up several folds. Those who have been in the market since, let's say, 2016, they would have seen demonetization. They would have seen the crash after 2018, shuffle of small caps out of mutual funds. Uh, Again, 2020 COVID crash. So they would have seen several of such situations. But in the last 4, 5, 6 years, we've not had a situation where the markets didn't go anywhere for a year and a half, and that is happening for the first time in the last so many years. But if you see over a longer period of time, let's say you go back 20 years, 30 years, there have been several such instances where the market has taken its sweet time to consolidate the gains that have come in a short period, to do a time correction, to allow valuations to catch up, to build a base from where they have launched the next move up. And usually, even in stocks or in indices, when that base formation is happening or that consolidation is happening, most people will give up in that phase, because they are so used to the idea that money should be made every month, every quarter, every year, that they are unable to bear some periods of nothingness or some minor losses. So the attempt is to somehow create a situation where you can be mentally prepared for the long haul, where you are accepting that yes, this interim losses that come in the market are a part and parcel of this equity game that we have come to play. And the fact that we have a strategy where we know that even though there may be losses for some times, when the mood changes in the market and when the trends form, we will make it, and much more than that, when the trend is in your favor. So depending upon the strategy that you have, I'm talking about momentum strategy, but other strategies also, uh, you should know that when your strategy will do very well for you, and what kind of gains will come at that point of time. And hence, given that you know that scenario, that those gains come in those periods, I'm willing to bear the nothingness of this current period. So with that sort of context, I want to show you some more numbers. Yesterday I tweeted this, that of the 988 stocks at NSE which are above 1000 crore market cap, so I did not even take the nano caps and the micro caps below 1,000 crores, where the situation is actually much worse. But just to remove all that, very very smaller market cap out of the calculation, uh, 58 stocks were down 80% or more from the all-time high. So if it was at 100, it is down below 20 now. 130 stocks were down 60% or more. So it includes those 58 stocks of the earlier line. 394 stocks, which is almost 50% of the market of this current segment, are down 40% or more. So 40 to 80, 90%. 710 stocks are down 20% or more. So almost 70% of the market is down 20% or more. And almost some 90% of the market, or 85% of the market, is down 10% or more. So there are losses of various degrees, and I shouldn't actually call them losses, but there are, I mean, these are the situations of drop from all time highs that has happened at various points. That all time high may not have come in the last 52-week only. For some stocks it may have come 2 years back also. So this is the sort of overall situation that exists uh, in the market. The Nifty, however, is down maybe about 10-11% from the top. So the Nifty, or the Nifty Next 50, or the Nifty Junior is not really, or even the CNX 500 is not giving you that picture which the broader market is telling you. The broader market is showing us much more pain that is evident in the indices. So if all stocks of this 988 stocks above 1,000 crore market cap only were, all, if we consider them equal and all are legitimate stocks, then the average stock above market cap of 1,000 crores is down 40%. So assuming that, the average portfolio out there would be having an average of these stocks, and I think I'm making a lot of assumptions here, but nevertheless, just to get some thumb rule situations, uh, one can say that most portfolios are down 40% or so, uh, in those terms. uh, why we are at this situation? In 2020 and 2021, we saw a huge liquidity gush by the central bankers who were pumping in stimulus in various economies, especially the US, to push the market upwards, to provide liquidity in the hands of the people, to provide situations where banks will not default, uh, and money supply was going up dramatically. So when money supply goes up dramatically, there is more money in the system, and it was available at 0% interest rate or near 0% interest rates. So all kinds of leveraging was happen. You borrow at 0.5% and you invest somewhere. You borrow at 2% and you invest in the real estate. So on and so forth was happening, especially in the US market, and things were getting a bit sort of orgy like situation with the respect to money supply. And now when the money supply has been contracting, uh, and the Fed tried to close the tap of the money supply, the market and people who are used to now easy money are having trouble dealing with the situation. People have leveraged like crazy, and banks have given out the kind of uh, loans at very very low interest rates, fixed for the next decade or 2 decades. And now the bonds that they hold and the assets that they hold have been marked down because of increasing, very sharply increasing interest rates. And hence, the entire system is very very wobbly. The banks, small banks in the US, have started to collapse. And if you go and see the US banking situation, I mean, it is nowhere near as robust as what we have in India. I mean, we must congratulate and be thankful that we have a regulator like RBI, and banks which are very very robust compared to uh, what we are seeing out there. So the US has had to, the government and the Fed had to come in and guarantee every deposit, which itself is has a moral hazard, because if you will backstop any risk taking, then the bankers can really go on a high risk path in trying to do more leveraging more business with their assets. So banks have started to collapse. I'm not trying to say that there'll be a collapse in the markets or anything like that, but every time the markets drop, basically it is due to lack of liquidity or shrinkage of liquidity. So the market is actually a liquidity game. We can nuance it or have a very nice narrative about a lot of things about any stock or management or opportunity out there, but everything starts and stops with the liquidity. If there is liquidity flowing into any stock, regardless of its fundamentals, it will go up. If liquidity is coming out of any stocks, regardless of that fundamentals, it will come down. That is the sort of the cardinal principle of the market. Now, uh, with this shrinkage of liquidity, we are staring at interest rate cycle going up very rapidly, and it is causing things to break down. Now that cannot be allowed to happen, because politicians will have a tough time controlling their vote banks if people are out on the streets and are complaining about inflation and complaining about loss of jobs. In the US, for instance, there is no perceptible slowdown in the job market, but people are feeling the pinch in terms of the money supply and the inflation. So we are probably very near some sort of a interest rate hike top, because the system is collapsing. If we are going further, maybe one or two more maximum. But now the market is somewhat signaling, the yields are signaling that the interest rate cycles may have topped out. The downside of all this is that every time we've had a recession in the past, every time the interest rate cycle has stopped, the bottom has come after the interest rate cycle has stopped. So if we are topping off in the interest rate cycles right now, the bottom is still far ahead if history has to repeat. So from that perspective, the mood and the prospects are a bit somber going forward. Here in this chart, you can see how the money supply growth has worked, and you can see that every time the money supply has crashed, you've had a market issue. So whether it was year 2000, mid 90s, 2008 here, but right now it has gone to an extreme where the money supply is actually in the negative, which had not happened in the last almost 100 years. So we are in sort of historical territory. This is some of the charts of what kind of a black swan event can happen in a stock. This is PacWest Bank, one popular small cap bank there in the US. PacWest Bank Corp is down like 82% in 2 weeks. Western Alliance is down 90%. Just imagine being a shareholder of a stock like this at 75 rupees and it goes to 7 rupees in like 4 days. First Republic Bank, you all must have heard, 140, 150 just last month, and now at 18 rupees at the bottom. Signature Bank is another one, 150 rupees last month and 60 now. So crazy kind of falls in the US markets. So versus Indian markets, where we've down 55% or 6%, and maybe from even from the top we're down maybe like 10%. So we are extremely fortunate that we are sitting with very minor losses compared to the kind of drops that we've seen in overseas market. Of course, we've had our bunch of stocks that have really done poorly. As I said, about 5% of stocks are down more than 80% also. But given that this kind of volatility is there in the markets, uh, we need to be extremely cautious, and we need to have our action plan ready. How that action plan will work out, of course, is not in our hand. But unless we have a plan that we will deal with a market and a volatile market in this way, if the black swan event happens in your stocks, you will not be able to react because there was no plan in the first place. And just holding and waiting is not a plan in my view. If we compare the Indian markets, how they're placed versus other markets, so this is FY20, so January 22 onwards, last 15 odd months. Uh, the S&P 500 is down 18%. The Hang Seng index is down 16%. Europe, this index is down 2 to 3%. Moscow is down 25-26%. Nifty is still flat. I think that is very, very good news compared to the rest of the market. So, but also we need to see that Nifty being, about 10% for drop from its all-time high, versus a lot of other indices much lower. However, your portfolio is not Nifty, and your portfolio needs to be a more to have a more realistic check as to where we are in terms of Nifty. Also on Nasdaq versus Nifty IT, Nasdaq, and this we are seeing from the COVID bottom. Nasdaq is still up 70%, but Nifty IT is up 145% from post COVID. So even the IT stocks are doing reasonably well versus the companies that they actually serve mostly. So from that perspective, even this sector has done quite well. Advanced decline ratio. This is a chart from mcharts.com. This orange line is an advanced decline line, and you can see that this has been a constantly falling advanced decline line, where the blue line is the Nifty. So while Nifty was increasing here, the advanced decline line was flat or negative. So we really did not, in that June to December run, the underlying nature of the market did not change from a falling market to a rising market, but it was a intermediate sort of bounce, and we are currently losing on the advanced decline rapidly. So from that perspective also, the market is showing weakness in terms of the internals of the market. So summing this up, so again, only 3% of the stocks are 5% or lower from the all-time high. 4.4% are up from 5 to 10%. So about 7.5% stocks is where the relative strength is. So if there was a way where you could only have these 7.5% stocks in your portfolio would not be more than 10% down. And that's what relative strength or momentum investing, in a way, rotational investing will do for you, where it will not allow the stocks that fall rapidly to stay in your portfolio. So this big chunk of stocks that has gone down from 10% to 75%, which is the major part of the market, will be the ones that will cause the most pain and will be the most difficult to get out. So every portfolio falls, but the whole theme should be that, can I make my portfolio to fall less, and am I able to switch to stocks that will come out of that hole faster? That is the key to the entire game. So the idea is that we must try to make our losses, or the drawdowns on a minimal level. And whether returns are high or not in a long term in any strategy matters, but it is kind of overrated. The bigger part is versus the benchmark, can you have a drawdown which is lower? Because when you, like I always say, there is an analogy that when you're running on the road and you fall into a ditch, and if that ditch is and two runners, let's say two runners were running, and one runner was faster, one runner was slower. The faster runner was expected to win, and both fall into a ditch. The slower runner fell into a 3 feet ditch, and the faster runner fell into a 15 feet ditch. The slower runner will still get out of it and run and finish the race. The faster runner will not be able to get out of that 15 feet ditch, even though he was running faster earlier. So lower drawdown is very, very important, even if your overall returns in that small period of time, before you hit the drawdown has been lower. If you are lower return, if lower drawdowns are there, you will be able to come out of it much faster. And if your strategy is able to switch to stocks which currently are leading the market, just like a momentum portfolio, then you will always remain with the strength in the market. uh, as soon as the market will gain strength, you will gain strength with it. So this is also the same depiction, where if you start at the same point, the first year is the same for both portfolios, gaining 100%. But the second year, this portfolio drops 25% and this portfolio drops only 12.5%. And in the third year, again, both portfolios gain 50%. But the final outcome of both the portfolios is very different. They started from 100 and ended at 125% gain. This started from 100 and ended at 162% gain. Even though one and year three were the same in both, and only the drawdown was different. So the drawdown is very important, and that is what the message of this video is, that despite the losses, if you are able to limit your downside, and also have the ability to switch to stronger stocks when that switch happens in the market, you will be a winner in the long term. So with this thought, I'll leave you on this episode. Thank you so much for watching. Please do share this with your friends and family, and let us know if you like the content, and we will see you in another video. Bye.